Good afternoon, good morning, everybody, depending on which part of the country you are in. We're really glad that you're able to join us today for our annual 2023 federal budget summary from OFO. I have in front of me here a media pass. This is the pass that we used yesterday. Henry was with me as well. Henry Shue, I'll introduce in a moment. We were in the federal budget lockup yesterday and enjoyed a day of being, sequestered, locked away with the budget materials, reading it, pouring through it, and coming back with a presentation for you today. So hopefully you'll get some good information out of today, what took place in the budget, what was announced, what's relevant to you, and most importantly, what kind of planning ideas now come out of the federal budget, which we will be talking about today as well. But joining me on the call today is Henry Shue, who is our Managing Director of Tax here at OFO. And Henry will be the tag team today. We'll be going back and forth, kind of sharing information with you. Also joining us in a few minutes will be Neil Nisker, my partner and co-founder in our business. Neil has some things he'd like to share today as well, a little bit about, we'll talk a bit about what he wants to share shortly. But in the meantime, thank you for joining us. We have a good group today. And if you have any questions as we go through this, I want to invite you to simply go to the chat function or feature at the bottom, click on chat at the bottom of your screen and type in your questions. What we'll do is at the very end, we'll save some time if we can to get to some of your questions, and hopefully we'll get to as many as we possibly can. If we can't get to them all, we will either contact you after today or either by email or by call, and make sure you get your questions answered. Okay. So with that, I just want to share with you, I will pull up on screen here our presentation for the day. You can also get a copy of this a bit later as well. So we will make sure that becomes available to you. We've titled this presentation, Green Tech, White Teeth, and Living in the Red. And, the budget was really about three things primarily. It was about green technology. It was about healthcare initiatives, and specifically, there wasn't a lot in the budget about healthcare, except for the dental plan, the Canada Dental Plan, which we will talk about today. And so hence the term white teeth in our presentation, and living in the red, because many Canadians today, because of inflation, high interest rates, are experiencing a challenge trying to make ends meet. And certainly our government is no different. Our government is still in a deficit position, which we'll talk about. So the government is living in the red. So green tech, white teeth, and living in the red is the name of the presentation. By the way, we spent probably 20 minutes reading through the budget material and about 6 hours to come up with the name of the presentation. I think if that's about, no, maybe it was the other way around, Henry, I think. But nevertheless, we have lots of information to share with you today, and we're glad to do that. Just to share with you what we're looking to do today, the agenda for the day is that we'll be presenting a bit of an economic overview of what's happening in the Canadian economy. Hope you'll find that interesting. We'll present some tax measures, personal measures, business measures, and other measures, including some that were previously announced that the budget may have mentioned or dealt with. We'll come back and talk about those. We'll talk about some non-tax measures as well, and then some planning ideas that might be relevant to many of you. So hopefully you'll find that really helpful. We will spend some time, as I said at the very end, taking some questions from people. So let's move into our discussion about the Canadian economy and what's happening. It's what you'll see here is that our economy, if you look at the graphic on the left-hand side, is actually at 103% of the size that it was prior to the pandemic. Actually, it was, if you go back in time a little bit, it was in the fourth quarter of 2021 when our economy returned to pre-pandemic levels. And since that time, there has been some growth. And you can sort of see on the left-hand side here, in this red circle, where we are at today. We're actually above pre-pandemic levels. In Canada, as far as G7 countries go, we've had the strongest recovery in the G7. And you can see that on the right-hand side. You can see Canada at the top of the list. This is really growth over the last year. Okay, we've been at the top of the list of G7 countries. We have posted the fastest growth over the last year. But as far as just recovering from the pandemic, we're near the top of that list as well. We're in, I think, second place of the G7 countries in terms of recovery from the pandemic. So economy-wise, the economy has grown since the pandemic, including looking at the labor market, it's a very, very tight labor market today. So about 830,000 more Canadians are employed today versus the pre-pandemic period of time. Unemployment today is at 5%. And that's really near the all-time low, which was 4.9% not very long ago, just a few months ago. So it is a tight labor market. There are lots of job openings in Canada, and it's hard to find employees if you're a business today. Many of you may have experienced that if you happen to have businesses today. That's sort of the state of the labor market. Now, when we take a look at real GDP and growth projections, it's interesting because despite the fact that we've got a very tight labor market and the growth has been good coming out of the pandemic, economists are projecting that our economy will start to slow. In fact, in September of last year, so just 6 months ago or so, the economists had projected a certain amount of decline or slowing down of our economy. And since that time, specifically last month, those same economists even lowered the projections even further. So given the fact that we've got an increasing interest rate environment, things are starting to slow down a little bit. You can see from the circle on the left-hand graphic, the little black dot there represents the projections for growth that were presented last September by economists across the country. You can see that the gray shaded bar area now represents what economists are thinking today in terms of growth for 2023. So positive growth, but very nominal. Probably 1/3% growth for 2023 is the projection. And as the economy slows, in fact, the unemployment is expected to rise, and it's expected to go up to about 6.3% by the end of the year. So that's where we're at in terms of the outlook for the balance of the year. But we can't have a conversation about where we're at as a country unless we talk also about inflation, because inflation really still is a major global economic challenge. Inflation reached its highest point in decades in June of last year. In fact, it was 8.1% was where inflation was last June. Now, the inflation rate has come down to 5.2% last month. So we are seeing inflation trend in the right direction. That's, of course, because interest rates have been increasing at such a rapid pace since last summer. So, but really the inflation rate, due to commodity prices falling, supply chain bottlenecks easing, interest rates rising, and demand is normalizing, that's all brought inflation back down to 5.2%. It's still a far cry from the 2% target rate that the government has always had, the Bank of Canada has always had. And one has to ask the question, is the 2% rate even realistic in the relative short term anymore? And should that rate be a little higher than that, the target inflation rate? We'll find out over the next few months whether the government changes, the Bank of Canada rather changes its target rate for inflation. Interesting to note as well, since June of last year, what has happened to prices? We mentioned that inflation is easing a little bit. You can see at the chart on the right-hand side that the price of many things has actually come down since June of last year. One exception to that are groceries. So if you happen to go by buying groceries, you'll notice that prices are still higher, even higher than they were 6 months ago, even since last June. They continue to go up. That's one area of spending that is not easing off yet. And that may change, obviously, as the economy starts to slow down, as we expect sometime later this year. Now, I mentioned that coming out of the pandemic, growth in Canada was resilient, has been resilient, but as we mentioned, it is starting to slow now. Inflation is coming down. And really one of the consequences of that moderating growth have been, the moderating effects have been really felt in the housing sector. If you want to take a look at the graphic on the left-hand side here, you'll see this shows home sales, house prices, and housing starts in Canada. And what that graphic really shows us is, if you take a look at the black line going across the middle of the page on that left graphic, that represents the 2019 averages for home sales, housing prices, housing starts. What you can see by the dark black line is that home sales have fallen off. Home sales did increase quite a bit during the pandemic, but they've come down quite a bit. Resales are down 40%, In fact, prices are also down 16% from the peak in February of last year. That's overall across the country on average. Certain markets have obviously felt a steeper decline than 16%. Toronto and Vancouver may have experienced, higher declines than that. But also, I think the thing that's worth mentioning here, if we look at the graphic on the right-hand side, is this is a measure of consumer confidence. So what we're seeing is that inflation and higher interest rates are reflecting on consumer confidence. You can see the black line on that chart on the right-hand side really represents the measure of consumer confidence, which obviously at the start of the pandemic hit a significant low. Today, consumer confidence is coming back down again. Again, this is partly because, what we're seeing in the economy and people are aware that there is going to be a slowdown. There is a slowdown we're now experiencing. That's why inflation is coming down. And that's why GDP growth is expected to be lower than originally thought for this year. Now, what I'd like to do right now is take a little poll. So if you're on the call, you can participate in this poll. I'm going to ask Raquel to bring up our first poll. Let's really measure consumer confidence here of those on the webinar. So when you think about the next 12 months, what do you expect your level of spending to look like? Okay, just pick an answer. A, I will be significantly increasing my spending. B, I will be increasing my spending somewhat. C, be maintaining my spending about the same. You'll be reducing your spending or significantly reducing your spending. Let's see where people are falling on this poll. We'll give you a couple of seconds to tally up the results. I just want to get a sense as to how people are feeling about the economy and where we're at, because people tend to spend less money if they're not feeling very positive about the economic outlook that they face. So we'll just wait for a few more votes to come in. Okay, so it looks like it's trending that we can see that we have about 51% of people plan to maintain their spending at their current level. In total, about 19% of you are looking at increasing your spending, either a little bit or significantly, and about 29% will be reducing their spending either somewhat or significantly. So there is a bit of a weighting to reducing spending, but most people, about half, a little over half, will be maintaining their spending. That gives you kind of a sense of where people, how people are feeling. Let me just see if we can share the results here. I apologize if you couldn't see the results. So here are the results. You can sort of see where people are at. And that, I think, is probably pretty reflective of what we're seeing across the country as well. Okay. So there we go. Let's move on now to the next slide I want to show you. Next issue I want to talk about related to our economy, and that is the deficit that we're facing as a country. So in the budget, you can there are a number of measures that were introduced that increase spending, not significantly, but we are still expecting, if you take a look at the numbers, a budgetary deficit this year of $43 billion. Now that's much better than where it was a year ago. Last year, it was about $118 billion deficit that the government experienced. And the year before that, which was, of course, high in the peak years of COVID, it was about $340 billion deficit. So things have improved, but we're still spending significantly more than we probably could be or should be. Having said that, we'll talk a bit about what some of those spending measures are. You can decide for yourself whether it's going to put money in your pocket or not, whether it's going to help you or not. By the way, if you take a look at the net projection for the next 5 years, we go out to 27, 28, and you can see a declining budgetary deficit each year for the next 5 years. But even 5 years from now, the government's projecting a small deficit of 14 billion. So we're not going to see any balanced budgets over the next 5 years. So that does mean additional debt, national debt, that we're going to have to live through, that the next generation is going to have to live through, especially. And let's just take a look at what that looks like right now. So as of today, our federal debt is almost $1.2 trillion. You can see that here in the circle in red. The government doesn't like to think about actual dollar numbers when it comes to the debt. They prefer to think in terms of debt to GDP, right? Or debt to the size of our economy in Canada. And right now, the federal debt is about 42.4% of GDP, or 42.4% of the size of the Canadian economy. Now, 5 years from now, the debt's going to be higher because we're forecasting deficits. The government's forecasting deficits over the next 5 years. But the overall debt to GDP ratio is not going to change significantly. It will come down a little bit. That's the projection, but not significantly, and will still be about 40% federal debt to GDP. I also want to talk a little bit about graphically what this debt number looks like. You can see here on the left-hand side, it shows the forecast for our federal debt. Again, always as a percentage of GDP. The government really is intent on downplaying the actual level of debt and interest charges and focusing instead on what those numbers are as a percentage of our economy or GDP. So you can see that the number is going to slowly come down over the next few years. But if you take a look at where we're at today, really in 2023, we're about at the same level we were at back in about 2002. So go back 20 years, that's about where we were at in terms of our debt to GDP ratio. Now, at that time, it was coming down very quickly and significantly, but we're sort of back where we were at 20 years ago. And on the right-hand side, you can see public debt charges, which is really the interest on the debt. You can see that because interest rates have gone up, we're expecting an increase in interest charges or public debt charges as a percentage of GDP. Still a lot lower than what it has been in some years. Back in the 1990s, for example, the mid-1990s were a very high debt to GDP and interest to GDP ratios. We're better than where we are. We're at that time, but still the numbers are trending in the wrong direction. So, we want to see that, obviously, the debt under control. Moving on to a couple of other things here, just to continue our debt picture a little bit. Our net debt as a percentage of the economy is still lower today than in any other G7 country, even prior to the pandemic. So if you look at the circle in the red circle on the very left-hand side, you see Canada, there's our level of debt to GDP. And if you can see it, not sure you can see it well enough, but there's a little triangle in that black bar, and that represents where we were in 2019. And even in 2019, even though we're a little higher than we were in 2019, even then in 2019, prior to the pandemic, we were better off than a lot of the other G7 countries and continue to be better off. So the government likes to point to these pictures because obviously makes us, they're hopeful to make people feel better about the level of debt that we have as a nation. Also, as far as deficits are concerned, Canada is looking like we will have the smallest deficit in the G7, both this year and next year. You can sort of see that on the graphic on the right-hand side. The black line really represents our deficit, and the gray shaded area that you can see there, which is even worse than ours, lower than ours, represents the range of deficits that other countries in the G7 will be experiencing over the next couple of years. So, again, the government likes to point to these kinds of pictures. Lastly, I want to talk about interest rates for just a second here, and policy rate expectations. So globally, most central banks are set to maintain their policy rates at elevated levels in the short term. Now, this, along with any ongoing stresses in the banking sector globally, which could amplify the global economic slowdown by, for example, restricting credit, could mean lower rates this year. So markets are now expect some pullback in the second half of this year in policy rates, particularly in Canada and the US. Now, as a side note, because I mentioned banks here, the budget materials were pretty firm on the idea that the Canadian banking system, the Canadian financial system, is well equipped to cope with what else is going on in the world, that our banking system is obviously one of the strongest in the world, and the challenges our banks face are not some of the same challenges that we've seen south of the border, in some of the other banking issues that have come up in the last 2 or 3 weeks. So government is very optimistic on all of that, and we don't have any reason to be concerned about our banks and our banking system. Anyway, it looks as though rates may come down somewhat later this year, but that will also depend on what's happening with inflation and the economy overall. That I hope you found to be helpful in terms of a snapshot of where we're at as a country, and the economy and our labor markets and inflation and everything else. We should turn our attention now to some personal tax measures. Now, I want to introduce Henry Hsu. Henry is our Managing Director of Tax, and Henry, as I mentioned earlier, joined me in the federal budget lockup yesterday. And Henry did a lot of writing yesterday. I'm sure you were getting hand cramps, Henry, more writing than I even did, and I did a fair bit yesterday myself. But Henry's going to walk us through some tax measures now, and I'll kind of chime in with my 2 cents from time to time. Over to you, Henry.
Well, thank you, Tim. So the first thing I want to start talking about is actually to say what is not included in the budget. And the worry that a lot of people are saying is that the budget may include the raising of the capital gains inclusion rate, but it didn't. It still remained unchanged at 50%. And this has always been sort of like a rumor starting back in 2016 or 2017. But here we go, we're still at 50%, which means a lot of the capital gains remuneration planning is still available for taxpayers. Another thing that we thought that would be in budget 2023 is this introduction of a wealth tax. Again, it's not there. One thing that was kind of surprising, though, is because of what the US did in the Inflation Reduction Act, where there's a lot of green initiatives, and we know that the federal government is trying to push the same kind of initiatives. What was missing is actually things that may benefit average Canadians, for example, a subsidy on purchase of electric vehicles, or even any kinds of rebates to help upgrade your home or appliance to be more energy efficient. Now, these are the measures that the states actually have implemented, but unfortunately, we did not see this in this year's budget.
In the US, in fact, people can receive up to $3,200 US annually, I'm not sure if it's just this year, but I believe it's in the next couple of years, to make improvements to their home, whether it's replacing doors, windows, new insulation, things like that. There was nothing like that. There are crickets chirping when it comes to what was in the budget for Canadians personally when it comes to green initiatives.
Actually, in the States, they also give rebates for people to install solar panels in their roofs. So maybe one day we'll see it in Canada as well. Last but not least is something called the General Anti-Avoidance Rule, the tax avoidance rule. Later on, I will talk about that there are some changes to it, but what is not in the budget is that the burden of proof to prove that a taxpayer is doing some transaction to avoid tax is still with the minister, not with the taxpayer. So that's good news. Moving on, the first, I would say the big headline for this year's budget is something called grocery rebate. Tim mentioned earlier that all these like spendings, consumer spendings has kind of reduced, but grocery still remains strong. And because of that, inflation on grocery is still going high. The federal government prides that they are announcing this measure, which will cost them at least $2.5 billion to help about 11 million low-income individuals and families. And it's basically a credit that they give out to these families based on their income level. And what they're saying, though, is this is not a permanent measure. It's more like a one-time thing where they're going to pay it out twice the amount that people have received for January 2023. So that's about like $450 to modest income Canadian families. But they will also raise the phase-out rate gradually so that some of the families with a little bit higher income can still get some of these GST credit.
Just a comment here on this one. I think, many of the people who will be on this webinar may not qualify for this grocery rebate, but if a lot of you have children or grandchildren who are younger, who are over 19 or older, but still not earning a lot of income, they may actually get some money back from the government because of this measure as well. Yeah.
Next, something not significant, but it helps a tradesperson where if they have being employed and they're required to purchase new tools for their jobs, they usually can deduct $500 to purchase new tools, and the budget just doubled it to $1,000. Next is the RESP. Now, this is for families to kind of help their children save money for education later on, either for college or for university. But what the current rule has for RESP is that there is a limit. And the current limit is you can only withdraw $5,000 for full-time students during the first 13 weeks of enrollment. and $2,500 for part-time. What they're saying though is that they want to increase the withdrawal limit to $8,000 for full-time and $4,000 for part-time. Now, I just want to clarify that doesn't mean that that's all you can withdraw. It's only for the restriction is only for the first 13 weeks, which means after 13 weeks, technically there is no limit. You can withdraw as much as you want. And another change is that now they also enable divorced and separated parents to open joint RESPs for their children, which surprisingly that wasn't available before.
Yeah, that was crazy. I don't know why, parents who are separated or divorced couldn't jointly open up RESPs, but that's been rectified now. So good news there.
Moving on, the Registered Disability Savings Plan, RDSP. Now, this one is a little bit more of an administrative thing, where if the adult individual's competency or mental or physical competency is limited, the rule says that, well, the plan holder has to be that person's guardian or legal representative. So it was a little bit more restrictive, and getting legal representative status kind of time consuming. So there was a temporary measure that allowed family members, which includes parents, spouse, or common law partners, to be the plan holder. But they think that that's not enough, and they now want to extend the definition to include siblings. And they're also extending this temporary measure by 3 extra years to 2026.
Yeah, that just makes sense. So if you're a sibling or a parent of a disabled person, you can set up an RDSP without having to be the legal guardian, which just makes complete sense.
Now, the last personal tax measure introduced this year is the overhaul of the alternative minimum tax, AMT. Just to give you some background, what AMT does is that every single taxpayer in Canada, you're actually subject to tax under 2 systems. You're under the regular system and also the AMT system. So the regular system is you're basically paying tax at whatever income tax bracket that you have, but all the preferential items will still be given to you. For example, capital gains are still taxed at 50%. Whenever you donate public securities to charities, there's no tax, there's no capital gain, but you're just paying tax at your income tax bracket. What AMT says is that, no, we're going to kind of disregard some of the preferential items, and then we'll recalculate your income. And if your income happens to be higher than the exemption amount, which is currently $40,000, then they apply a tax of 15%. So this system just ensures that people pay like at least some level of tax, even though you have all these preferential items. So what the government thinks is that a lot of taxpayers may not be paying their fair share of tax even under AMT system. So they're trying to tighten up the system by further denying or reducing preferential incentives. So as you can see here, for example, for the purpose of AMT, they are increasing the capital gain inclusion rate from 80% to 100%. They are including, for employee stock options, 100% of the benefit is considered income. Now, even if you donate public securities to charities, they will still put 30% of that capital gain as part of AMT. And they also deny a bunch of expenses, not denying, sorry, I should say reducing it to only 50% deduction on childcare, interest, non-capital loss carry forward, limited partnership losses. So a lot of items just to, let's call it, broaden the base of AMT. And not only they broaden the base, but they also raise the rate from 15% to 20.5%. But as you can see here, one good news, if you will, is that they do increase the exemption limit from $40,000 to $170,000, but they are indexing this, so hopefully it will go higher and higher. But they are reducing the non-federal refundable tax credit by 50%.
Yeah, so I think, Henry, I think people don't realize is you're right. There are really 2 tax calculations that get done. One is the normal calculation. One is the alternative minimum tax calculation. And if your tax is higher under the AMT, that's the amount you pay. And then I think at the end of the day, these changes are really to make no bones about it. We'll collect more money from higher net worth and higher income Canadians than in the past. Yes, they've increased the exemption amount to 173,000, but all that really ensures is that anybody who's paying AMT is in the highest tax bracket, basically, or higher income earner. But they are going to overall collect more minimum tax. And just to be clear too, if you do have to pay alternative minimum tax, then that amount, that extra amount of tax you're paying, more than what you would have paid under the normal system, you get that back over the next 7 years as a credit. That hasn't changed, right, Henry?
Yeah, no, that is 7 years. And someone from finance must have calculated that even though they increased the limit or broadened the base, that they'll still make money from it. And what the budget is saying that they will generate about $3 billion of revenue over the next 5 years because of this change.
So let's talk about some business tax measures now that were in the budget.
Yeah, so the first thing that jumped out from the budget is the introduction of the employee ownership trust. Now, this is a brand new vehicle introduced by the government that kind of facilitate business owners to sell their business to their employees. Just to be a little bit specific, the employees cannot be the business owners themselves or person related to it. So let's say children. So this is strictly arm's length employees only. And what's the benefit of this? Well, the benefit is that the business owners still get capital gains treatment, and also they can get a capital gain reserve that goes from 5 years to 10 years. So you don't need to include that income until maybe 10% every year, if that is the amount that you're being owed by this employee ownership trust. And another good thing is that the employees don't have to pay for these shares out of their own pocket, because the funding of the purchase price comes from the retained earnings of the corporation itself. So the way it works is, you can imagine that a business owner basically sell the company to this trust, and because the trust needs to pay the business owner, the trust can actually borrow money from the underlying company just to finance the purchase of the shares. Normally, because this is a shareholder that owns a company, there's something called a shareholder loan rule, where if you don't repay back the company within 1 year, that becomes income. But just to facilitate the transition to employees, finance basically say that, oh, you don't need to include income until the 15th year. So that's good news right there.
I think, the jury is still out on how much people will take the opportunity to use these employee ownership trusts in very specific situations where an owner doesn't want to pass the business to the family or keep it in the family, or where doesn't have an opportunity to maybe sell the business elsewhere and really wants the employees to effectively own it. You could use these trusts. The employees don't take ownership of the shares directly, though. They are entitled to dividends on the shares. And if the company is never sold, then yes, the employees will get their share of the sale proceeds. But no employee can actually say, I've got these shares in the business and I want to sell them now. Or if they leave the company, they can't, sell their shares back. So there are some drawbacks to the employee ownership trust, but time will tell whether this is adopted by people.
Yeah, that's right. And then there are actually even more restrictions, because if you think that, oh, I'm just going to sell to employees and I still can have some kind of influence, but no, they actually tightened up so that the founders and a related person actually cannot comprise more than 40% as trustees of the trust or as directors of the company. So what they really want is that they really want the founders to actually sell the company to the trust, so that the trust have a controlling interest of the company. And but as what Tim said, the trust cannot allocate any shares to the employee beneficiaries, meaning the employees cannot sell it just by themselves. And they're really only getting the money as dividends, and then the distributions is based on what the trustees think is appropriate. Following the same theme of transferring business, now this one is not to arm's length employees. This is more like to families, especially to the next generation. So in the past, what people have done is that they like to convert dividends into capital gains, which is known as surplus strip. And this made massive headline last year, where there was a private member's bill, Bill C-208, that kind of allowed surplus strip to happen, but really the intention is for business owner to transfer their businesses to the next generation. So obviously the government didn't like that last year, and they vowed to say that, oh, we're going to tighten up this rule to make sure that, yes, we're doing a genuine intergenerational transfer, but at the same time, prevent people from doing surplus strip. So what they introduce is that they actually introduce two different rules. I'm not going to get into like a detail of what the rules are, but I'm going to tell you high level. What they're saying is that for the immediate business transfer is that they want the parents to sell it to the next generation immediately, relinquish control right away, and also common shares. But then they allow the management of the business to transfer to the children within like 3 years. So everything has to be immediate. But then they say that, well, not all businesses do that. Like sometimes it's a gradual transfer. So they talk about this other rule called a gradual business transfer rule, where they say, okay, you know what? You still need to relinquish legal control, but the beneficial ownership, you can do it over 5 to 10 years. But then the owner, so the parent, which freezes the shares and take back frozen preferred shares, you need to reduce your frozen shares by, like, say, 30% within a certain period of time, like within 5 years or something. So there are two rules there. It's a little complicated. There's a whole different legislation about it, but we can always chat about it if you're interested to learn more.
I think, this all came about, this whole conversation about transferring businesses to the next generation became a really big issue a couple of years ago, because our tax law, before any recent changes, would actually make it cheaper from a tax point of view, more advantageous or cheaper to sell to a third party outside the family than it would be to sell to your own children. And that was not, that was not very good. People didn't like that. So they came up with these rules in Bill C-208. And in June 2021, they became law, and that fixed the problem. But there were loopholes, and some of those loopholes have allowed people to strip money out of the corporations at capital gains rates rather than dividend rates or salary rates. And the government says, well, wait a sec, we see people are using these new rules for that reason, and not to really bring about a true, genuine transfer to the next generation. So yesterday, they closed up some of those loopholes. Now, those changes are not coming into effect until January 1st next year, I believe, right, Henry?
That's right, yeah.
Well, in fact, between now and January 1st, the next 8 months, there is some opportunity to do some planning, to take advantage of the existing rules, to still pull money out of your corporation at capital gains rates rather than dividend or salary rates, which could be advantageous. So if you want to talk to us about that, give us a call.
Like these rules are definitely an improvement. It does try to facilitate what the reality really reflects, but it's not perfect.
Yeah.
Moving on to some of the big headlines that you probably see. As I mentioned before, this is in a response to the US Inflation Reduction Act, because they are spending, we're talking about, I think, like $370 billion, I'm talking the States, on green initiatives. We are trying to match it in a way, but more to apply on businesses. And they're trying to give out investment tax credits on businesses that, for example, produce hydrogen, produce geothermal energy, clean electricity, produce heat and water, and manufacturing like nuclear energy equipment. So there's a lot of big items that the government is trying to do. And I think it's cost them about like $55 billion or something, Tim, like through the next few years. Large dollar amount of money, but unfortunately, as I mentioned before, this is really only targeting to businesses.
And large businesses at that,
Yeah.
Unless you're an individual who has, really good ideas about how to convert hydrogen into clean ammonia, in which case you might be able to get some tax benefits too. But that's sort of where we're at with these benefits. Like, it's really the largest corporations that are going to benefit from these. The green initiatives were not meant for the average Canadian in this budget.
I mean, the government's hoping that the expansion of this green tech businesses or economy will employ more people into this field. So I guess if you're, let's say you're a chemical engineer or nuclear engineer, yes, this does benefit you.
Yeah.
The next item is more on the public markets. So this is, again, a response to what the US is doing. And also there's some, like public policy on why they're doing it. A lot of public corporations over, I would say, during COVID, they made a lot of money. I'm talking about like big tech companies. And rather than reinvest the profits back to the business growth and employees, they actually use the money to buy back the shares. So they're repatriating profits back to the shareholders. So just to make the price look better, I guess. US didn't like it. The US say, okay, we're going to tax it because you're not using these dollars on the economy. So government's trying to follow the same thing. And then here you go, they're introducing a 2% tax on the net value of the repurchase of equity, which is basically the fair market value of the equity they're repurchasing minus the amounts that they're issuing from Treasury. But this really only applies to public corporations or REITs only, not to private companies. And they have a bunch of exclusion. Let's say, for example, reorganizations are not included in this.
Right. So share buybacks are, for Canadian companies, are going to be penalized.
Yes.
Short term. Other tax measures, Henry, let's talk about GAR.
Yeah, so GAR is basically a tool that the government likes to use just so that people don't partake in tax avoidance transaction. And if the government successfully challenges you in a GAR, what it really does is that it restores you back to where you should be, but not impose a penalty. And there's like a bunch of like tests where GAR will apply. But what this year is that the government kind of wants to really strengthen the anti-avoidance system. And can we look at it in the next slide to see that they're actually introduce a bunch of measures. So the first one is they want to add a preamble on GAR to say that, hey, if this is this is what the intention is really to be on the interpretive issues. So the court can look at this and say that, yes, this is what GAR is supposed to do. Another thing is that they're tightening the definition of avoidance transaction so that instead of being a primary purpose test, they're going to be one of the main purpose tests, so that if you did a transaction where you say, well, that is not where I'm trying to avoid tax, I'm actually doing it for other commercial reasons, then the CR can actually attack you because they say, well, that is one of the main purpose is to avoid tax. The last one is actually the one that is going to be troublesome, is they are introducing something called the economic substance test. So they'll say that, hey, if you partake these tax planning ideas and strategies, but if they pierce it through and they say, what you're really doing is purely tax motivated and it results in no change of economic position, then they say, well, it lacks economic substance. Something must be happening. GAR may potentially apply to you. But at the same time, they're saying may not be true. So we'll see what the court will say about that test. And they're actually imposing a penalty at 25% of the tax benefit. So we'll see what happens to GAR, and there's a consultation period till the end of May 31st, 2023.
So this whole issue of GAR is really frustrating to me because, many years ago, and you'll remember reading about this, Henry, back in 1936, there was a court case called the Duke of Westminster. And that was a British court case, but it's quoted and cited many times in Canadian tax cases. And what that case was about the Duke of Westminster, who in England at the time did some tax planning and managed to get some tax deductions where he otherwise might not have been able to deduct some costs. In fact, he was deducting the cost of his gardener at the time, which typically wasn't a deductible expense, but he managed to structure it in a way where it was deductible. And he went to court over it and he won the case. And the judge said in the case that a person has the right to structure their affairs in such a way to pay the least amount of tax that the law will allow. So it has to be legal, but you're allowed to structure your affairs so as to pay the least amount of tax. And that's been the case for many years. But then back in call it 15, 20 years ago, the government introduced this thing called the General Anti-Avoidance Rule. And basically what that rule says is, if we don't like your tax planning, we just don't like it for whatever reason, we can deny it, or we're going to try to deny it based on this general catch-all rule called the General Anti-Avoidance Rule. And so what they've done this year now in those rules, because they haven't really been changed in the last few years, these rules, is they've really tried to make them even have a tighter stranglehold on Canadian taxpayers to make sure that people really have a difficult time doing advanced kind of planning, even legitimate legal planning, if they don't like it. So that's the problem I have with this. It really kind of throws out the window that idea or notion that we should be able to structure our affairs in a way to pay the least amount of tax as long as it's legal. Government says, yeah, but if we don't like it, we still might deny it. So That's the problem I have with it. Anyway, just venting here a bit.
No problem.
For some people, they may have, this may be the best slide of the day for them. So go ahead.
Yes, so normally any kind of alcohol, spirits, wine, and beer, they usually go up automatically on April 1st because excise duty is indexed to CPI. But the government, I guess, they're trying to give some goodies to average Canadians and say that, hey, we're going to temporarily cap. That doesn't mean that they're not going to raise it. They still raise it, but they're just going to cap it at 2% for just this year only.
So bottom line is this year, your beer, your wine, your spirits will not go up as much as inflation has. So there you go, for what that's worth. Okay, some previously announced measures.
Yeah.
You want to talk about this, Henry? Sure.
Sure, yeah. So this is something that was introduced last year called the Tax-Free First Home Savings Account. It's brand new register account. It's available to adults, residents of Canada. And it's basically an amount where if you contribute to this account, it's deductible for tax. And if you withdraw, and as long you use it to buy a home, that is not taxable. So it's kind of like the best of both worlds with an RSP and a TFSA in terms of you can deduct, and when you get it, it's not taxable. And the only condition is you just need to buy a house. And this was announced last year, but finally it will be available in 3 days. April 1st.
This one's a no-brainer. I've read about this in the Globe and Mail. I think that anybody who qualifies to have one of these accounts should open up the account because there's no downside to it. If you put money into these accounts, it's deductible like it would be in an RSP, but you don't face tax when you pull it out to buy a home. And if you choose not to buy a home, no problem. Just take the money, roll it into your RSP, and it doesn't even use up your RSP contribution room. You get this additional amount that can go into your RSP if you choose not to buy a home. So there's really no downside to this. And again, finally, at long last, these things will be available on April 1st, a couple days from now. And again, something that we're going to be encouraging everyone who qualifies to open up one of these.
This one is specific. If you have family members who are seniors or disabled that wants to live with you, the government's encouraging family members to be more inclusive. And if you need to renovate to allow these family members to live with you, they are providing financial relief, which is about a credit up to $50,000 of renovation expense. So 50% of that amount is about $7,500. And this credit is available this year.
Starting this year. So that's good news.
Last but not least is the underused housing tax. This was a law that was enacted last year in 2022. So it's already been in effect for the whole calendar year 2022. What this does is that it tries to penalize houses owned by foreigners that are not being used to earn rent or to be occupied because of the tight supply of the housing market. And they're assessing a 1% tax on the value of the property each year that you have to pay. But if you're an excluded owner, you don't have to pay. And excluded owners will include individuals who are Canadian citizens or permanent residents, any public corporations and charities. Now, as you can see, a company is actually not part of the excluded owner. So if you're a company that owns these residential property, unfortunately, you have to do something more. So you have to meet a bunch of other conditions, like you need to rent it out for occupancy, or because you have to renovate it, or because there's like a death of the owner or something like that. So that is how you get out of not paying a tax. But nonetheless, these non-excluded owners still need to file a tax return. And I would say, Tim, a lot of Canadians probably don't know about this, that this tax return is actually due next month.
Next month. Yeah, exactly. So just to be clear, if you own a residential property, even one unit, one home, even a duplex, just whatever it is, inside a corporation, or in fact, in a trust or partnership, then you've got to file. You may not have to pay the tax, but you have to file by April 30th. And there are steep penalties, right, Henry, for not filing?
$5,000 for individuals, $10,000 for non-individuals. So it's very, very steep. But it's funny enough, 2 days ago, the government announced something new, is that they realized that a lot of Canadians don't know about this rule. So there is a transitional relief where if you pay if you pay the tax and you file the return by October 31st, 2023, then they won't levy this penalty.
Right, right. Okay, before we jump to the next section, which is really just a few more things to talk about in the budget, not many more things, a couple of things. I do want to take another poll here. So this is poll number 2. We're going to ask the question, do you expect that you or any children or grandchildren will open a tax-free first home savings account? So based on what you know about these things, how many of you expect that you will be opening these things up? Definitely will, you likely will, not sure, not likely, definitely won't be. I'd like to know what the numbers look like here. And this may actually be partly based on the demographics of those who are, on the call. But I think that's why we worded the question, do you expect that you or any children or grandchildren might open up one of these accounts? Let's take a look at what the results look like here. So it's pretty even across the board. It looks like overall, probably 47%, almost half will say somebody in the family definitely will be opening up one. 53% or 16% are not sure, and the balance about 38% probably won't be setting these things up. Interesting. I think, again, my comment on that is that if somebody qualifies, they really should have one. It's really a no-brainer. It's kind of like a TFSA. You may say, well, it's not a big number, it's not a lot of money, but you know what? For young people who want to put money towards a home and are need to save some, it's a great vehicle for that. Okay, let's talk about some just non-tax measures, then we'll wind this up with some questions. Let me chat about a couple other things that were in the budget. Reducing junk fees. No, this has nothing to do with cleaning out your garage or anything like that. Junk fees are hidden fees or unexpected fees that many of us pay. Things like internet overage charges, mobile roaming fees, event and concert fees, excess baggage fees, some unjustified shipping and freight charges. People have complained about these things. The government has listened, and the government's intention is to work with regulatory agencies and provinces to reduce junk fees and bring in legislation that will control some of those things. So that you might find that coming down the pipe. For students, the budget did increase student grants by 40%. So those who qualify can now get up to $4,200 for a particular year for full-time students. That's up from $3,000, so an increase to granting. Also, right now, there's a certain amount of student loans that you can receive that will be eligible for no interest-free loans. They've raised the amount of loans that can be borrowed at an interest-free on an interest-free basis to $300 per week of study. What that means is that in a typical school year, a student who's eligible could borrow up to a little over $10,000 and not have to pay any interest on that loan. So that's positive for families who need that help. Also, there's a waiver of the requirement for mature students, those who are 22 and older, to undergo credit and screening checks for student grants and loans. And all these changes are to begin August 1st. Now, for those who like to travel, there's a few things to keep in mind. The government has committed $135 million to address delays in processing times for passports and immigration applications as well. So people looking for permanent resident status, because those things have been very, very slow. And they'd like to get the average passport application time down to 10 days for most applications if they can, 10 to 20 days. That's the goal. They're also providing over $1.8 billion over the next 5 years to the Canada Air Transport Security Authority to improve screening wait times at airports and to strengthen security. So hopefully waits at airports will be improving. The budget also promises new legislation to strengthen airline obligations. This is important, to compensate passengers for delays and cancellations. So if you've experienced delays and cancellations on flights, there could be compensation coming to you, and more compensation maybe than there has been in the past. So airlines won't be happy about that, but that's just a fact of life for them. To pay for some of this, the air travelers security charge, which is a fee that gets added to every plane ticket, is going up effective May 1st next year. It'll increase by about a third. It's not a huge number, but it will increase the cost of your plane. It could increase the cost of flights by $25 or $30 over the course of each time you fly. Internationally, domestically would be a little bit less. Also, the budget talks about something new called the Canada Dental Plan. Now, in September of last year, the government introduced something called the Canada Dental Benefit, which was for children under 12. But they've expanded those benefits now the budget provides $13 billion over 5 years, starting this year, and $4.4 billion every year after that to implement this Canadian Dental Care Plan. What that does, it's going to provide dental coverage for uninsured Canadians with family incomes under 90,000, and for those who have incomes under 70,000, we're talking about family households here. There's no copay amount either, so it's completely free. The coverage the provided coverage will start by the end of this year. All right, so more details will come as the year progresses. For small business owners, credit card transaction fees are going down. Will probably drop by about 27%. Government's negotiated that with Visa and MasterCard, so that will be coming probably in the coming weeks. Also, for small businesses, the government's changing its procurement processes to make sure that Canadian businesses, especially smaller Canadian businesses, have a chance at getting government contracts and projects. I mean, that should have always been the case, but you know, Canadian businesses were competing against international companies for some of those projects. Well, there's now going to be a federally funded, a program to try and improve the number of projects and work that Canadian companies get. Okay, let's finish this off by talking about planning today. Henry.
Yeah, so a lot of these ideas is what we've mentioned earlier today. For example, we're talking about Bill C-208, because the new rule is not going to be in effect until Jan 1, 2024. We still have an 8-month window to take advantage where if you want to have a genuine business transfer, you can still do it and take advantage of the better tax rule until January 1, 2024.
Yeah.
And then the next one is that because of AMT, where I mentioned that the capital gains inclusion rate goes from 80% to 100%, perhaps you can realize some capital gains now to take advantage of the lower inclusion rate for both the regular system and the AMT system. So that's probably a no-brainer on that.
I think, you know, we keep talking about this. I still stand by the idea that the capital gains inclusion rate will go up. We believe it will go up at some point. It wasn't this year, or wasn't in this budget, could still happen at some point. So we still plan for that. You know, it can in some cases still make sense to sell things at a gain. If you're planning on selling them anyway, let's say in the next 3 or 4 years, it could make sense.
Yeah.
Okay.
Ownership of business with a trust. So I got this idea based on the restriction of employee ownership trust where founders and children cannot be beneficiaries. So then if you want to multiply capital gains exemption with the family, you cannot use the EOT. You have to use a regular trust to do it. So I would still suggest a regular estate freeze and then introduce a trust to own the operation business early, because you still need 2 years for the capital gains exemption to multiply and give it to your children, for example.
If you're thinking about transitioning a business either to family or employees at any time, come talk to us, because we can certainly help you with structuring all this properly and taking advantage of the tools that are available.
Purifying corporation. This is not only for claiming of capital gains exemption in the past, but a lot of these budget 2023 rules require that the company to be where 90% of the assets are used in an active business for both Bill C-208 and the employee ownership trust. So if you can purify it, please do it this year.
Absolutely. We talked about the tax-free home savings accounts. We don't need to dwell on that. We do think it's pretty much a no-brainer, and you should be doing this if you or a family member qualifies. And lastly, just related to some insurance strategies, there are some good strategies that are out there. You know, we don't sell insurance, of course, but we do planning with it. But these ideas are still available. You know, these things are not affected by capital gains inclusion rates if rates go up. So there may be some opportunities to do some planning using insurance to either cover taxes on death or fund buy-sell agreements or equalize an estate or gift to charity. There's a bunch of things you can do with it. So we're glad to share with you more ideas later. Okay, we're going to pause there. We're near the end of our time. Maybe Neil, I'll pass it over to you to have a conversation with everybody. And we're glad to have a couple minutes to take any questions.
Thank you, Tim. There are a few questions, but first, let me thank both you and Henry on behalf of everyone listening, how informative this was. There's a lot. I can't remember the last time that we've had a good budget. Unfortunately, everything's being politicized these days. And obviously this budget will pass because it was written with the pen of the NDP to some degree. So we're not talking politics on this call, but the good news is, and we have to think of this as where the good news, they didn't raise the capital gains inclusion rate, and there's some other good news as well. And I just want to say that I'm so proud of our tax team, Tim, Henry, and the other members, that I would put our tax team up against any of the big four accounting and planning firms out there. Now, we have a few questions, so in the final minute or two, let me ask you, Tim and Henry, one of the questions is, are there any tax incentives or federal funding in the budget for technology startups?
Henry, do you want to talk about that?
For this year's budget, I actually don't see it. There are none. As I mentioned, all these green technology incentives are really for big companies, not necessarily for technology startup. And I don't see any federal funding for this either.
There may be some things that were introduced in prior years that you can still take advantage of some tax incentives like accelerated depreciation and things like that, but nothing really in this budget.
The next question is for EOT. Do the owners remain trustees of the company's trust?
The answer is yes, they still can, but they cannot comprise more than 40% of the trusteeship of the trust.
So you really are giving up control when you use an employee ownership trust. You have to give up control. And that will be one of the disincentives to using them, but for people in the right situation, it may still make sense.
Yeah.
Thank you. And last, if you can spend just a minute defining or what's meant by purifying.
Purifying really means that you want your company where 90% of its assets are used in an active business. Sometimes what businesses do is that they accumulate enough cash and they use the cash and park it and invest in, let's say, the portfolio market. That will taint the company so that it's not considered pure. So in order to purify it, there are strategies to extract those passive assets outside of the company so that the company is ready to be used for whatever reason, to be sold, to be used on EOT, or to transfer to the next generation.
That's right.
Thank you, Henry. Listen, let me thank everyone for your attendance on this call. I wish you a good afternoon. I also want to say that, for those on the call who are not families, who I think we've served quite well, not just from a planning perspective, but you should be aware of what's going on in the markets these days and in the economies around the world. We play offense by playing defense, and serving ultra high net worth families, it's not how much you make, it's how you keep from losing. And I'm happy to say that those who unfortunately had a 60-40 model, the plain vanilla model that's been used for the last 50 years, were down 16% last year. And I'm happy and excited to mention those who aren't families on the call that we preserved our family's wealth last year. So if you'd like to learn more about how we preserved our family's wealth, please contact us. And lastly, I just want to wish everyone in advance happy holidays next week, Easter, Passover, whatever you celebrate, be grateful and thankful for your health, for the lives you have, your children and grandchildren, and know that, our family office, 5 years, we're doing great, winning awards, serving our families well, owned by some of the families we serve. And it would be great to have further conversations with you in the future. So have a wonderful day. Thank you again, Henry and Tim. I don't know if I'm more confused now than I was yesterday, but I appreciate the education. Be well, everyone, and thank you again.
Thank you.
Bye for now, everyone.